Hello and welcome. My name is Grant Collins. I'm with AIM Research. And once again, I'm joined with Eric Basmajian from EPB Macro. And Eric, you and I got together for really the last couple quarters of 2021. Always enjoy our conversation. So I thought it was going to be great again to bring you back in for Q1, kind of hit on what we're seeing out here in the marketplace and what we're seeing in the new quarter and in the new year. So how you been? How's everything been going?
It's good. It's good. Happy New Year. Happy New Year to everyone listening. A lot has changed over the past couple of weeks since the last time we spoke. Not so much in the way that things are trending in the economy, but more so in the reaction function in the market. People are starting to wake up to some of the points that we were hitting on over the past couple of quarters: the slowdown in the economy, the slowdown in growth, and then the tightening that's coming into that slowdown with the slowdown of quantitative easing and eventual stop of quantitative easing and all these rate hikes that they've built into the curve. When we were talking before offline that the belly of the curve, the 2-year and the 5-year, are pricing in 4, almost 5 rate hikes.
They're certainly, in my opinion, I think they're getting out ahead of them and getting ahead of their skis a little bit. And so I think we'll be able to spend some additional time and dig into that. But maybe I can start, Eric, and give a lay of the land.
Yeah, that'd be great.
And then maybe you can piggyback and maybe hit on some more nuances there. So what I want to start with here, Eric, is maybe just a couple of things that I'm seeing. And let me know if that screen share.
I can see it. Yep.
So I want to start with just broad financial conditions in general. And we know that we have now started to hear the tapering conversation. We went from $120 billion a month, and we've been scaling that back as they've been trying to rein this thing back in. And you're right, they're talking about 4 interest rate hikes over the next year. The 2 measures that I look at are the Chicago Fed National Index and the Kansas City Financial Stress Index. No surprise, they lead each other very well. When you start tightening financial conditions, you get more stress in the system in general. So what we're seeing is, yes, conditions are still easy, but your directional change is starting to really set in. And that's coming, in my opinion, from, and I want to get your take on this, the things that I look at are the gaps in the economy are closing very quickly. So your output gap for potential versus real GDP, we still had a gap here as of the third quarter, but if you pull in the estimate from the Atlanta Fed nowcast, which you and I talked offline, I think that 5.1 might even be a little bit rich on their end. It may even come down well south of that. But if they do, in fact, get that, you could see the output gap close at the same time that you've got the unemployment gap that has closed now down at 3.9, 3.8%. And then inflation, we all know, is running well above their 2% target. And that's really where all of this tapering and this rate hike conversation is coming from. The Fed's looking at all these metrics that they're seeing, and they're like, okay, we now have to pivot and change course. So I want to kick it back to you after setting that lay of the land and ask the question, what has changed? Because you and I have been hitting on this now for a couple quarters, but it seems like you mentioned at the beginning of the call, that everybody's starting to wake up to it.
Yeah, so we were talking about the slowdown that was happening in the economy for the last couple of quarters, and I think that the narrative has slowly started to change. The narrative started as, okay, this is a benign slowdown from what was a very high growth rate, and we're going to slow to something that's closer to a trend rate of growth, and then we're going to be able to march along. I think that was always a flawed assumption because the economy always moves in cycles. Everything is cyclical. There's no such thing, or I've never seen a period where the growth rate stops at 2% trend and then moves directly sideways for 5, 6, 7 quarters. It's either going to go through trend or it's going to pivot and start to cycle higher again. So we're always talking about the rate of change. Is it declining or is it accelerating? And if I could pop a couple of charts here, we can see what's going on and the developments that have happened over the last couple of quarters. So this chart, and let me just pop this up here. Can you see that?
Yep, you're good.
Okay, so this chart here is the coincident index that I publish very frequently. For those that are not familiar, this is a composite of real personal income ex transfer payments, industrial production, non-farm payrolls, and real consumption. These are actually basically the four indicators that the National Bureau of Economic Research uses to date business cycles. So this wasn't a sort of cherry-picked basket of indicators. This is sort of what sort of measures the real economy. And this is only updated as of November, because real income and real consumption haven't been fully updated for December. But what we could see here is the peak that we identified in March and April, and then the slowdown that was happening. And we started to talk as the economy was slowing to 5%, 5.3% based on the way this index is calculated. And then the growth rate never picked up. People talked about this acceleration that was happening in Q4. And if I use this alternate index, which uses retail sales and aggregate income, so I can get a sort of estimate of what December is going to look like, we see that the growth rate is actually continuing to fall sharply through Q4. So the narrative about this pop that was going to happen in Q4 is sort of rapidly fading. And I think that realization is really playing into the market dynamics that we're seeing. The GDP number for the Atlanta Fed that you noted is still quite elevated at 5.1%, but it also should be noted that 3 percentage points of that is coming from inventory. So real final sales are actually only 2%. And GDP is probably overstated over the last couple of quarters, because we had a 2% inventory build in Q3. Now we're going to have another 3% inventory build in Q4. So in 2 quarters, we put 5 points of inventory into these GDP numbers. And we know that over the long run, over 5, 6, 10 years, these inventory contributions net to zero. So as we get into 2022, everyone's going to have to ratchet down their 2022 numbers to account for the inventory draws that are going to happen. And then the other point that I want to mention is what's driving this slowdown. What's driving the slowdown, and why is the economy not able to sort of pick up the slack that the Federal Reserve is going to, they're going to remove accommodations, and now the economy is tasked with basically handling things on its own. And the big problem is real income. You showed a chart of inflation rising to 7%. And what's happening is that it's just destroying real income. So we don't have any real income growth at all since the start of the pandemic. We're way below the trend line that was established in the pre-COVID expansion. And this is excluding government transfer payments. And what's happening is that consumers are falling behind. So we hear a lot of stories about wage growth, and people are saying that wages are growing at 4 or 5%, even 6%. And these are the highest numbers we've ever seen in decades. But you need to contextualize that against the inflation rate. The inflation rate's also the highest that we've ever seen in decades. So if wages are growing 4, 5, and 6, we can't cheer just yet if inflation is 5, 6, and 7. And the manifestation of that is that real incomes are declining. The growth rate in the economy is not able to pick up as the Fed's going to remove accommodations. So they're going to continue tightening into this slowdown. And I think that's what the market is finally waking up to. So those are kind of the updates on my end.
Yeah, and I think that hits the nail on the head, that they're going to be tightening in a slowdown, right? Before we kind of turn to the Fed, I do want to hit on that inflation one more time. So let me pull up a couple of slides that I have here for our viewers. Did that come over okay?
I can't see the screen yet.
Here
yep,
we go.
Now I can.
So I do think it's important to understand where this inflation is truly coming from. So if we look at the top areas that we saw inflation, oil, of course, was one of the big ones. You feel it at the gas station. You probably feel it as you go through wintertime this year. Transportation, we saw the used car market and the new car market go ballistic. Mm-hmm. Then at the same time, you've got food and beverage and shelter. So literally, to your point on real personal income, you've seen a dramatic decline and the consumption is just following with it, following directly right beside it.
Exactly. This is a
Now,
great chart.
one of the things that I have that may be a little bit different than others, I do believe inflation is going to be decelerating, but I think it's going to be sticky. And it's primarily because of how much liquidity they've thrown at it. I mean, Eric, they've thrown everything in the kitchen sink at this thing.
Mm-hmm.
So you're seeing a chart here of M2 demand deposits, and of course, the total assets by the Fed. And one of the big questions that I'm trying to answer, and what I even wanted to ask you, is the feed through mechanism, right? So you're seeing a chart here of percent change year over year, yellow line in demand deposits, accelerating almost 120% year over year, where at the same time, money and balance sheet has expanded as far as well. Now, all of my research says, a year and a half, somewhere in that range is where that finally starts to leak through to the economy, right? But we know this time is a little bit different, right? Because the support came directly to families and not indirectly through financial markets, right? It did a little bit of both, but the 3 rounds of stimulus, the Paycheck Protection Program, the child tax credits, right? So when I'm looking at my estimates for, call it the inflation gap going forward from here, Q1, Q2, Q3, Q4, add 2% for the target, you're looking at 7.25% for Q1, 6.75% for Q2, call it almost 7.6 for the rest of the year, right? So
Right.
I'm curious. I know it's decelerating. I even feel it's going to decelerate because we're seeing things like the Baltic Dry Index come down.
Right.
We're seeing supply chains get alleviated as people go and return back to work. But what are your thoughts on this inflation sticking long term, or do you think it's going to go back to the 2% trend that it was on before, or below 2%?
So I think it's a question of time frame. I think that in 2022, I think that yes, the inflation rate is going to come down. I think some early indications that it already is coming down. I calculate some of these measures on a shorter term 6-month annualized growth rate, and from November to December, we had inflation based on the way that I calculate it fall from 7.7 to 7.4. And we have the producer price index based on that 6-month growth rate that I use. The producer price index peaked about 5 months ago, and the import price index peaked about 6 months ago. So we do have some indications that this peak in inflation is already underway, at least cyclically. There are obviously these swing factors like oil, which continues to rise, which is driving it higher. So I think that the near-term path of inflation could stay higher, but as we get out into 2023, 2024, I think that the structural forces in the economy are just so strong. The demographics, the aging demographics, the slower population growth, and the higher debt levels. I think those 3 factors together are going to normalize the inflation rate pretty quickly. It may not happen in 2022. We may stick a little bit higher, and it could turn out to be 2 or 3 years where inflation is sustainably above 2%. But I don't think this is the start of a new permanent regime where many years from now, inflation has never come back down below 2%. And if that is the case, then all that's going to happen, in my view, and this is something that we talked about a couple of quarters ago, is if the inflation rate does stick at a higher level, all that's going to mean is the real growth rate is going to stick at a lower level. And the problem with that, and I think it feeds into the chart that you were showing about bank lending and the feed-through mechanism, is real GDP per capita or real disposable income per capita. Those real income metrics that I showed you are the closest measures that we have to the standard of living. That's how people actually feel. So you could give someone a 5% wage bump, but if inflation's 20%, they're not going to feel very good. They're going to feel worse. And we know that all of this money creation, or most of it, is endogenous, meaning it's not controlled by the Fed, right? It's generally controlled by bank regulations, the bank's willingness to lend, and the consumer's willingness to borrow. The consumer's willingness to borrow to fund a new investment or a new productive project. And if the standard of living continues to fall because real income is declining, then consumers are going to be a lot less willing to borrow for productive type projects. What we've seen is credit card loans are really driving the increase in bank lending right now, which makes a lot of sense given the deterioration in real income. So what we've seen is real income go down, consumption start to follow. The savings rate has already dropped below the pre-COVID average. The average was about 7%. I think we dropped to about 6.8 as of the last one. So the savings rate's normalized, real income is fallen, and credit card usage is going up. That's not generally a recipe for consumers having a huge appetite for new productive loan growth, or businesses seeing that consumer. It's not a very strong consumer. It was sort of an artificially inflated consumer. Now we're sort of coming back to reality. And I think that the loan growth is going to be a lot weaker than consensus anticipates. I think this trend of a secular decline in the growth rate of loans is going to persist for that reason. I think if the standard of living is falling, then there's going to be a problem on the consumer willingness side.
Yeah, no, that makes a lot of sense, especially whenever we talk about the passing of the liquidity baton, right? Because right now it's all been coming from the fiscal and the monetary side. Right. But if you're going to have a sustained recovery, you have to efficiently pass that on to the private sector, and
exactly,
banks are going to have to start picking up.
Right.
I actually have a chart on that here too, Eric. It's something that I think is really important when we look at the liquidity factor going forward from here. And what we're seeing is the loan to deposit ratio, like you mentioned, is still extremely low following velocity of money. But another measure that I use that tracks this really well is also productivity. And this mechanism of, okay, well, if you're going to hand off, fiscal and monetary liquidity to the private sector, it's got to start with the banks by kicking off this, this rally and actually providing the loans out to the consumers and the companies that need them. But then it has to be productive.
That's right.
And we've got to get the productivity up. And I did a little bit of homework into this, and I want to show you. So I've got two charts here that are both impulse response functions of what would happen if we were to shock the loan to deposit ratio and the productivity measure that I have in here. And what would it do to velocity? And primarily when we shock a variable like this, it's a 1 standard deviation move to the upside. Okay, so if we had a 1 standard deviation move in loan to deposit ratios, what you're going to see is a positive move in velocity. So you almost get, this 1-for-1 shift higher as well, right? Same token, you get a 1-for-1 shift higher. If you were to shock productivity 1 standard deviation higher, you get velocity 1 standard deviation higher as well. The important part about that, Eric, is that when you shock velocity and you move velocity 1 standard deviation higher, it increases output dramatically. And where I think the economy is having so much trouble is once this money gets created, and I think you and I have talked about it, there's other strategists that have talked about it, it's just not productive. It's just not being put in the right places, and it's not moving the economy efficiently, and that capital is not finding the right home. So, we are seeing banks start to lend. Very, very small compared to where it's been, but it all is a matter of where it actually lands and whether that product, that lending actually creates an additional stream of income that actually flows through the rest of the economy that really, truly matters from here.
Yeah, that's a great point. And one thing that I would add, when I mentioned those 3 factors, bank regulations, consumer willingness to borrow, and banks' willingness to lend, those are sort of the 3 factors that tend to drive the velocity of money. And when I say consumers' willingness to borrow, I think it can sound like households, but I really mean private sector's willingness to borrow, banks' willingness to extend loans, and then bank regulations, and the interplay between the 3 of them. And what's synonymous with consumers' real income going down would be corporate margins getting squeezed. right? That would sort of be the how it plays out in the corporate sector. So if corporate margins are getting squeezed because of this higher inflation, and then consumers are just really struggling with this decline in real income, we're going to start to see this huge corporate margin pressure, which I think we're starting to see in some of these earnings reports that are coming out. Companies are falling pretty dramatically on some of these. And we could see a small increase in bank lending, and we are seeing it. We're seeing it in credit cards. We're seeing a small pickup in C&I loans. But is it going to be sustained? Can we sustain this for an entire economic expansion for 5 years, for 7 years? And I just don't think we can, because the forces are too strong to the downside. So we're going to see these little spurts, but we're not going to have, the economy, like you said, the Fed passed the baton to the private sector, and the private sector can kind of roll on its own. It's just going to trip, basically. It's going to trip, and it's not going to be able to get up. And then the Fed's going to have to come back in and continue to provide additional liquidity, which, as we both know, is not going to any productive uses.
No, and I think that may be a great way to segue into the Fed conversation, because the market, of course, is also reacting to not only tapering, coming out of the marketplace, but these interest rates also reaccelerating all at the same time too.
Mm-hmm.
And let's kind of use the example of inflation sticks around for 2022 and provides a problem for the Fed. And so now they have to make a very difficult decision, right? Do we raise rates while the economy continues to struggle and slow down from here, right? Especially if you don't have a pickup in loan to deposits, and you don't have a pickup in productivity to offset it and give you coverage to raise rates. Right. So I'm in the camp that it's going to be extremely difficult. And even when you look at, I'm going to pull up a chart of the yield curve here real quick for us, just to give everybody some reference here. I tried to update it from the numbers from yesterday. So you got the 10-year at 183 and the 2-year at 108. So 183 minus 108, you're looking at 0.75. Market's telling you at best they have 3 as cover. Right. And that's assuming that your 10-year holds there at 183. I don't believe it's going to hold there. I think if you and I are right and the growth rate does decline, because the base effects are really nasty when you use just like a moving average model, when you look at the growth rate in the economy, and that's going to continue to drag down growth unless you have true productivity. But what are your thoughts there? I mean, to me, it doesn't seem like they have a lot of room to run here.
Yeah, I don't think that they're going to be able to pull off what's built into the curve. And, a lot of people talk about this interplay between, are they going to save asset prices, or are they going to tackle inflation? We have to remember that they have a dual mandate: employment and price stability, right? So what if those two diverge? We haven't seen that ever, because people believe that low unemployment rate brings inflation. We know that relationship doesn't always hold, but the crux of a lot of this inflation is supply side driven, right? So we could have what's called a supply side recession, where the supply curve is shifting inward, cuts the price level at a higher price point, but a lower level of real GDP. So let's forget about asset prices. What does the Fed do if inflation is 5-6%, but we start having monthly job losses because the economy is slowing so hard, right? And if asset prices are coming down, if the stock market's correcting 10, 20, 30%, are companies hiring, right? So I think that they could have just a conflict within their dual mandate that's going to make their problem challenging enough. We've seen unemployment claims tick up the last couple of weeks. It's a short-term trend. We don't know if it's going to stick, but it's certainly consistent with the deceleration in the broader economy. So I think that they are going to have a real problem here. And we have to, I think it's always worth contextualizing some of the secular economic trends that the Fed is facing. Can you enable me to screen share? Mm-hmm. The Fed, we talked a lot about the cyclical trends, but this is the labor force growth rate versus the federal funds rate. The labor force growth rate being people over 16 that are either employed or actively searching for work. And the labor force growth is just one of the most critical inputs to the economy's trend rate of growth. The trend rate of growth obviously determines how high of an interest rate the economy could handle. And the labor force growth rate has been collapsing. This is on a 10-year smooth basis, and projections are that it's going to continue to decline. And not only is the labor force growth rate going down, the population is getting older. This is a relative share of the working age population. So this is population ages 15 to 64. Over the next 10 years, we're seeing a huge growth rate in the 65 plus population, seeing very little growth rate in the 15 to 64 population. And why is that problematic? That's problematic because all the consumption happens in the prime age cohorts. As soon as you get over 65, consumption starts to trail off really dramatically. And this is total consumption, which includes medical expenses and things like that. The real engine of the economy is housing and vehicles. That's the cyclical engine. And that consumption peaks in the 35 to 44 age bracket. So on a secular basis, there's no chance that the Fed can sustainably raise the interest rates on a 2-3 year basis. Cyclically, they may be able to get 1, 2, 3, 4 rate hikes off. It really depends on the underlying cyclical trend in the economy. So from 2016 to 2018, we had a strong cyclical upturn that was really fueled by a lot of real estate investment in China. And the Fed was able to get the Fed funds rate to 2.5 or 2.2. It obviously didn't last because these secular trends are just too fierce. But right now we have worse secular trends than that 2016 to 18 period. And we have a cyclical downturn instead of a cyclical upturn. So it's going to be really, really difficult for the Federal Reserve to even end the quantitative easing program. And we'll see if they can end the quantitative easing program. They're going to have to accelerate the pace of the reductions. And then once we get there, we'll see how many hikes are still built into the curve. But risk assets are starting to take notice that the accommodation is quickly leaving the room and the economy is going in the wrong direction.
Yeah, and that's maybe a perfect segue into asset prices and market interpretation in general, right?
Yep.
When I'm looking at how the market's pricing this, I'm going to pull up a couple more charts here. We're seeing that broad shift to defensives. If we just look at like the 90-day risk reward chart, so going back 90 days from today, you've got staples, utilities as probably one of your better risk rewards at the moment.
Oh, yeah.
The market's been pricing. You flip it over to the equity side, it's been low volatility and dividend payers. And then when you get in the fixed income, because we've seen these just broad moves in interest rates, it's really been cash, bank loans, and that's been about it. Like you now have this process of everyone kind of running for the exits all at once, or at least it feels that way as we turn the calendar on the new year and you're in January. And I think that's the other thing that we have to think about too is how long does the bond market and the stock market stay correlated together? It feels very, very similar to the early parts of 2020 when we were all hearing about COVID and we were all pricing it at the same time. It feels very, very similar to that. So, I mean, what are you all thinking? I mean, I'm in the camp that you remain defensive and you continue to stay in that camp for some time. You may have to stay in it for maybe the first 2 quarters of the new year. If I'm going to be bold about it, I think you'll be here for half the year.
Yeah, I think you're spot on. I mean, my framework is always that when you're in a cyclical downturn, that you have to get defensive. It's time to get defensive with your equity exposure, which is your staples, which is your utilities, your minimum vol. Sometimes your high dividend, quality dividend payers tend to perform better. At the very least, it's the time to get out of the high beta, very leveraged momentum stocks. I mean, we've seen total destruction of the really high momentum, high beta stocks, and that's partly to do with just how excessive things got with a lot of the stimulus and things like that. But it's also just very consistent with a cyclical slowdown that you see a lot of the air come out of these high flyers. Also, for me, when you're in a cyclical downturn, I personally find that the best thing to do is you want to hug the long end of the treasury curve. Now, it's a volatile path. It's choppy. It doesn't go up every day. But if we recall that coincident index chart that I showed peaked in March, April, that's when the 30-year bond yield peaked. And it's been one heck of a choppy ride. But we never got back to that March high in 30-year bond yields, despite how fierce the move in short-term interest rates was. The 2-year rate moved 90 basis points in 6 months, but the 30-year rate continues to grind lower. Mm-hmm. So I believe that in this environment, you want to be in your defensive equity sectors, and you want to hug the long end of the treasury curve with your bond allocation. And if the bonds don't go up in nominal terms, at the very least, we should continue to see a flattening. So I think you'll still outperform with the long duration treasuries, as long as the growth rate in the economy is slowing, which it is. And I expect it to continue slowing based on the leading indicators that I use. And then on top of that, if the Fed's going to amplify that effect with tightening policy, I think that that's where you want to be. And I think that the market is starting to price that in. I mean, we've seen a huge move in the yield curve. I mean, just 30s versus 2s is making a new low. You mentioned 10s versus 2s. So that's how I think about the asset market in the context of this cycle.
Yeah, so it doesn't sound like we have very rosy outlooks for any of the listeners here today. But at the same time, it seems like a lot of the problems that the economy was digesting are now all coming to a head. And because I think a lot of people forget this, but COVID came at the very top of an economic cycle. Mm-hmm. And I feel like people forget, but we didn't really have a true recession because we didn't get a hit to demand like we normally would. Right. I mean, when the Fed and fiscal policy steps in mass the way that they have, you get this smooth over and aggregate demand. Right. And I think that's the part that's now taking the hit. And that's where you get the undershoot in COVID, you get the overshoot in stimulus, right, and you return hard back to trend. And I think the fear is that you fall through trend. And that's, depending on how these base effects kick and roll off and whether or not we see how healthy the consumer actually is after they've got their stimulus checks behind them and their child tax credits behind them. Then and only then can we see how healthy the economy is post-COVID.
Right. No, I totally agree. The way that I think about it is that we never had a default cycle, right? Yeah. So we had a temporary shock to demand. It only lasted maybe 6 weeks or 8 weeks, but we never had a default cycle, right? Assets never went bad. Consumers never had to bear default. Banks never had to really suffer losses. And that's really important because recessions sort of cleanse the system of all the bad, unproductive parts, right? It sort of cleanses all the bad assets, all of the businesses that are unproductive, that don't really have the means to survive. And we probably would have started to see some of those businesses and a default cycle kick in because, as you mentioned, we were at the top of a cycle. The economy was starting to decelerate. And there was actually some talk in 2019, the Fed was cutting interest rates. We were heading slowly towards perhaps what was a mild recession. So we were going to see some of that cleansing effect. COVID happened and we couldn't indiscriminately pick businesses of who would fail and who wouldn't. So everybody got saved. And these are always the unintended consequences. But since we never had a default cycle, we protected all of the bad, unproductive assets, all the bad, unproductive businesses. And then we had the rebound. And now we're coming back down. And we're coming back down saddled with basically 2 layers of unproductive debt, right? Unproductive debt that was used during the COVID period and all of it from the prior cycle. So that's one big reason why I believe that we're going to go right through trend and actually establish a new trend that is even lower than the prior cycle. We've seen trend growth. People talk about trend. It's not a static figure. It kind of moves slowly. We've seen the growth rate in the late 90s go from 4%, then the early 2000s to 3%, and then the last expansion was 2%. I think this next expansion that we're going to end up with a trend growth rate that's materially below 2%.
Listen, and that's not too far off from if you do a very simple, just moving average of the GDP and just try to estimate it, again, going back to those base effects. I mean, it's going to be rock hard down to trend. And like you said, we might even experience an even further below trend. I mean, you look at the lower end of my forecast and you get into Q2 and you can see minus 335, minus 208, minus 3.5. And I use this moving average just for base effects only, right? You know, the economy is so much more dynamic than just taking a moving average, but it really does highlight what we're about to experience because you've had this undershoot, overshoot phenomenon. You're going to have a lot of this return to trend or this, you know, renormalization, if you will. And you know, I hope we've done our work over the last 3 quarters where we've kind of prepared those to continue to move into that defensive track and try to help and get you out the best way we can.
Yeah, no, I think that you know, if I may say so, I think that we have been on the right track for the past couple of quarters. I think we've been identifying what's going on. You know, risk in the market tends to happen super slow and then all at once. You know, I recall that, you know, we were talking about this tightening into a slowdown the last couple of times we spoke. I wrote a couple articles in September called "Tightening into a Slowdown" when the Fed started to signal that they were going to move in this direction. I wrote again in November and December, and sort of the market gets lulled to sleep, and then all of a sudden there's this wake up call. And I don't think it's going to be that easy to turn this around because of that inflation dynamic sticking, like you said, at least for 2022.
Yeah, and I guess if we could give, I guess, and at least in my mind, maybe it feels like this, but one thing I would like to maybe give our listeners is that, hey, we're not seeing the same magnitude of a sell-off just yet of COVID, right?
Right.
So, Eric, I've showed you these before offline, but I thought it would be worth bringing these on today to maybe let investors know that when you actually change the price data and look at it more from a Z-score perspective, and you look at it as far as how far are these things moving in standard deviation terms,
Right.
when you really truly have those, excuse my French, oh shit moments, they're 10 or 8 or 9 standard deviation moves. And
Right.
they're typically blindsiding moves. It's something that the market truly hasn't fully focused on, and they have to price it in all at one time, right? And what we're seeing is, despite everybody being concerned, we're still holding well within 2 standard deviations.
Right.
Yes,
It's been sort of a slow bleed.
exactly. And here's something that I have a question for you as maybe our as we close here. Because this is something we know about, is this a situation where maybe we get some just kind of this slow bleed even further, right? Where it just kind of continues as people just reprice and reprice and reprice as we get more and more information around this tapering, because it feels and looks that way when you look at multiple different things, like even the triple Qs. I mean, that's a hard move down, but it's not breaking that 2 standard deviation where it really turns into a more accelerated sell-off.
Right.
And that's a level that we're watching very closely to determine whether you can call this a full-on, you know, bear market, or if you call this
Right.
more of a correction and a repricing.
Yeah, that's a great point. I guess my last closing comment on that would be, whenever the growth rate in the economy is declining, you always tend to get corrections in the market. You tend to get more volatility. But the big, you know, crashes, those oh shit moments like you talked about, tend to be concentrated really more in recessions, which, you know, every recession occurs during a slowdown, but not every slowdown ends in a recession, right? So I would think to have a really high volatility, you know, multiple standard deviation type sell-off, we'd have to move from growth slowdown mode to, oh crap, there may actually be a recession here. You know, we're not just slowing a trend, we're blowing right through trend and we're going to a recession. Now, nothing on my radar screen right now is saying that a recession is an imminent probability. I would say that the growth rate's coming down. My leading indicators have not inflected higher, which means that the growth rate's going to continue to trend even lower, which means that every day recession risk is rising. But I wouldn't say that, we're on the cusp of a recession right now. So I would say, I'll have to update this every data point that comes in. But if we get closer and closer to a recessionary probability, that's when I think that you start to get the multiple standard deviation type sell-offs. And I don't think you can never take recession off the table when the growth rate's coming down, right? The momentum's heading down. And if you have an exogenous shock, that'll push the economy through a recession. When the growth rate's accelerating, it tends to shake off the exogenous shocks. But when the growth rate's slowing, if we have a shock, that could cause a recession. And we also could just slow right into a contractionary period. So it's not my forecast at the moment, but I would say that would be what would really shift the needle between what's sort of a relentless, there are kind of a buyer fatigue type sell-off versus a crash type sell-off.
I couldn't agree more. And I think that's why I love talking to you, Eric. You and I share very similar viewpoints and come at it from different angles. And I think to summarize it, and you can tell me if I've said any of this wrong, I think both of us agree that growth and inflation are going to continue to decelerate as we move through the first part of this year. And because of that, we're going to remain in that more defensive camp and continue to try to watch as the new data points continue to come in. Is there anything else that you'd like to add before
I think that you just said it perfectly. I couldn't say it any better.
Well, so just so everybody knows how to find us, again, I'm Grant Collins. You can go to myaimresearch.com, or you can follow us on Twitter at AIM Research LLC. Eric, just a quick plug there so people know how to find you and how to get a hold of you.
Yeah, sure. EPBMacroResearch.com. You could send me an email, eric@EPBMacroResearch.com, or I'm heavily active on Twitter at EPB Research.
Eric, again, always a pleasure, man.
Likewise.